Hi, Gabriel Josiah here. Today, we are diving into the capital gearing ratio, the ultimate tool for assessing a company's debt versus equity gain plan. Whether you're preparing for exams or sharpening your real-world financial analysis skills, this video is tailored just for you. Let's transform theory into practice as we take a deep dive into the capital gearing ratio. All right, let me share my screen as it's our custom, and let's look deeply into this fantastic ratio. I've gone many now, as usual. Okay, it's one of the main long-term solvency ratios, talking about capital gearing ratio, which measures the extent to which an entity's long-term funds have been provided by lenders. Lenders in the sense that these are external providers of capital and they are not owners of the business. So they include debt. It's a debt they are providing to the company, not equity. So it's very important to understand that the capital gearing ratio is geared at looking at the difference between the debt owed by the company and that of the internally generated funds by shareholders of the company. Okay, so the formula is stated on the screen and it's clearly a numerator or the denominator comprising of preference share capital, which is a long-term fund. They have fixed dividend for providing such capital, even though it's seen as equity. But preference capital have a fixed dividend or fixed interest in terms of dividend on that fund or capital provided to the company, inclusive of long-term debts of a year plus 5 years, 10 years, loans and bonds. And the denominator is the total capital inclusive of the equity and debt. So the aim is to see how much debt is the percentage of equity or the total capital structure of the company. It's very important. Okay, so the proportion of the company's capital that is financed through debt versus equity is what the capital gearing ratio is all about. And this is what we're trying to understand and comprehend. It provides insight into the financial risk associated with the company's capital structure and its reliance on borrowed funds. So externally borrowed funds and internally borrowed funds, we're trying to see the dichotomy or the difference between both. A higher capital gearing ratio indicates that a company has a greater proportion of debt in its capital structure. So anything above 50% shows the company is highly geared. Anything below 50 down to 25, it's moderately geared, while 25 down to 0% is lowly geared. In the risk assessment or the high, medium, low method, you can stratify that in that manner: low, moderate, and high, highly geared companies or gearing ratio calculations. Okay, so a more comprehensive ratio or formula is stated here as long-term debt, which includes preference capital and every non-current liability that has to do with borrowed funds, bonds, bank loan, and every other debt the company owes external providers of capital. And the denominator is the equity of the company, inclusive of those debts, to see the percentage of the debt to the capital structure of the company. So we've stated it where long-term debt includes preference share capital, loans and bonds beyond 1 year. Equity refers to shareholders' equity, common and preference stock or shares. Okay, so let's buttress this example graphically with our case study. I've been using Shareholders Nigeria PLC to calculate these ratios as you can see on the screen. So first, let's pick our preference share capital. As you can see in the SFP, we have preference share capital of 100 million naira at the end of the financial year, 31st December, not the 1st of December. You're taking 31st December at the end of the financial year to calculate this ratio. So if you have your calculator with me, just follow me. And let's do the plus and minus. I'll be using Excel here to calculate these ratios. So 100 million naira is our preference share capital, and we have that clearly stated. Okay, so that's an equity categorized share capital. So let's look at the non-current liability, which includes bonds and bank loans and bonds payable. And that is about 450 million naira. Take note, we can't use deferred tax liability to calculate debt because it's a statutory obligation and not a debt to the company, statutory obligation to the government. So it's not directly interest-bearing loan. It's commitment to the government that the company has to pay. So we're looking strictly at borrowed funds with interest-bearing elements. So we pick the bonds, bond payable, and bank loan, calculate this ratio. So we have that here, and this is 450 million naira. So our total long-term debt includes summation of three of the elements, which includes 550 million naira is our long-term debt. So let's go get our equity, which will add to the debt to get the numerator. Let's go get our equity. So our total preference and equity for the end of the year is 1 billion naira. So just get that and go and add it to our long-term debt. So how much is our long-term debt? Our long-term debt is 550 million naira is our long-term debt. So we have this summed up as our equity and long-term debt. Very simple. So let's sum it up, and we have 1,550 million naira. Now let's calculate our capital gearing ratio. So our capital gearing ratio is our long-term debt divided by our capital gearing, our equity, I beg your pardon, and long-term debt, which is 35%. 35%. So it means externally provided funds comprises of 35% of the total capital structure of the company. Very, very important. So take note of that. Externally providers of capital comprises of 35% of the total capital structure. So in our assessment, it may be low or moderately geared. Okay, so there's another variation or a variant of this gearing ratio where the debt is taken. So let's calculate that. The debt, total debt is taken only, let me use another Excel sheet, taken only as the numerator, and the equity alone is taken as the denominator. So this is another variant of the capital gearing ratio. Capital gearing ratio. So we could call that debt over equity ratio. It's also gearing ratio, but in percentage, because we're looking at how the debt of the company compares to the equity only. So let's see how the difference between the long-term debt divided by only the equity of the company, which is about 55%. So where you have just the total equity as the denominator, we have it as 55%, and the long-term debt is 55%, which shows the company is highly geared, because from 50% down to 100% shows the company is highly geared. Okay, so what does this mean? What do this calculation mean? It reflects how much of a company's capital is funded by long-term debt compared to equity. That's the meaning in percentage. A high ratio indicates a higher degree of financial leverage, meaning the company relies more on borrowed funds, which can enhance returns during good financial times, but increases risk during downturns. So it's very important to understand that borrowed funds are essential for the business, but it must be moderately done, whereby where we have downturns in the economy, low revenue, economic impact negatively on the business, external providers of capital will have a claim in terms of liquidation or where a dissolution of the company arises. This is critical. So the balance, talking about balance, is very important in the gearing ratio analysis. Implication is that a highly geared company or a high gearing capital gearing ratio suggests that the company will be more vulnerable to economic downturns, like we stated earlier, as it has a higher obligation to service its debt. Don't forget, some of these debts have interest expense that must be paid on the profit before tax of the company. So it's critical balance is struck to ensure that the company is not highly geared, should be moderately or lowly geared, depending on the industry where the company is resident. So conversely, a low ratio indicates a more conservative capital structure with less risk associated with debt financing. This can be attractive to investors, a lowly geared company, of course, seeking stability. So investors seeking stability are more attracted to a company that is lowly geared. But it may imply lower potential returns during periods of strong performance. So where the economy is booming and loans are procured, advantages could be utilized to get high revenue in such times and offset such loans and report very fantastic profits. Okay, so let's look at the cause and effect. The high gearing ratio is caused by aggressive borrowing for expansion. So one of the reasons for debt is for expansion, lower equity financing, or high interest bearing debt. And the effect is clear. It increases financial risk, greater obligations to pay interest and the principal at the same time, and potential challenges where we have economic downturns. While the causes of a lowly geared company or a low capital gearing ratio is conservative financing strategy, higher reliance on equity, or lower levels of debt. That's the cause of a low capital gearing ratio. While the effects is reduced financial risk, they're playing it safe. Greater flexibility in terms of financial distress, but potential lower returns on equity due to less leverage. So balance is very important, and risk is positive to some extent. If the moderate the risk, the moderate the return, and the lower the risk, the lower the return. And the higher the risk, the higher the returns to some extent, especially during economic. So management should deploy the skill and understand how to balance the capital structure of the company. So in conclusion, the capital gearing ratio is a critical indicator of a company's financial structure, revealing the balance between debt and equity in financing operation. So understanding this ratio helps stakeholders assess the financial risk and leverage of the company. A balanced capital structure is essential, and the word balance is the key word. So take note of that. As chartered accountants, we make such decisions. Balance is the word. Balance for long-term sustainability, and it enables the company to navigate economic fluctuations while maximizing growth potential. So it's essential you borrow to expand the business, to procure more profits, to increase revenue, to grow revenue. This is very, very important. Okay, so have a look at this fantastic metric. All right, there you have it. The capital gearing ratio decoded. Master this and you're one step closer to acing your exams and dominating the finance world with confidence. If you find this insightful, hit the like button, share with fellow accounting enthusiasts, and don't forget to subscribe to the channel for more powerful financial insights. Remember, finance isn't just numbers or number crunching. It's a strategy. See you in the next video. And until then, bye for now.